All right. Hi, everyone. We are live. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by CNBC senior stocks correspondent Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How you doing?
Good. How are you?
Well, it's been a wild week. Market's trying to figure out what's going on, so let's try to answer a few questions.
Yeah, sure. Let's jump right into it. So, first question, Bob. How is this ongoing crisis in Ukraine impacting the market?
Well, it's not good. And remember, most importantly, we have to bear in mind about this humanitarian crisis. People are dying over there, and that's the most important thing. But the big thing that's happening here is, and just economically, is this is really impacting the growth prospects for Europe. More than us, more than the United States. And the reason this is important for U.S. investors is a lot of our companies have very heavy investments over there. For example, consumer staple companies like Procter & Gamble, for example, a significant part of all of their revenues come out of Europe. To the extent that Europeans are not going to be in a spending mood or contracting because of the concerns about the impact on the Ukraine, that impacts those kinds of stocks. And the consumer staples names are down this week. But there's a broad picture here. Remember, before the Ukraine crisis, everyone was trying to figure out when inflation was going to peak out. 7% consumer price index year over year. That's a lot. That's the highest it's been in decades. That impacts people's habits, behavior. Gasoline is heading towards $5 a gallon. So everyone's trying to figure out supply chain problems associated with COVID has been creating inflation issues. And now we have this, which can create potentially another supply chain problem around things like gasoline or oil or natural gas. And so what the market needs is some evidence that inflation is peaking out, but we can't really do that, particularly with the Ukraine crisis ongoing. There's also been a slight shift in the discussion. 2 months ago, everyone was concerned about reflation. Basically, the economy was back. Spring was going to be really busy. Commodities were higher priced. Wages had been up, which for the most part is a good thing. And now, instead of reflation and inflation, a lot of the concern for the stock market has shifted towards stagflation. What's that? Stagflation means you have inflation plus no growth. A few months ago, we were having tremendous growth and inflation. So inflation plus growth is reflation. Inflation with much slower or no growth is stagflation. We had stagflation in the 1970s. It was not good for the stock market, not good for the economy. The economy, U.S., is still growing, but there is some concerns that even before the Ukraine, growth was going to slow a little bit. Now, it might slow a little bit more. The impact on global growth is very hard to figure out because we're in the middle of it. We don't know. Not knowing that, the market tends to get very conservative. So if you look at European stocks, for example, they're down about 20% from their highs. The United States, the S&P 500 is only down about 11%. There you see the impact very clearly. So the market's changing. Look what happened in the last 12 years from 2010 to 2022, what we had. It was extraordinary because the Federal Reserve was very involved after the great financial crisis in 2008, 2009, pumping a lot of money into the economy, and it worked. So what we had from 2010 to 2020, we had low inflation, we had low commodity prices, we had low gold prices, and we had very high stock returns. 15% average gain in the S&P every year, average between 2010 about 2020. The average gain in the S&P historically is about 10%. So instead of a 10% return average in 10 years, we had a 15% return. A lot of that was because the Fed was pumping money into the economy. Now look what we've got. We've got, instead of low inflation, we have high inflation. We have higher commodity prices. We have higher gold prices. And we have the potential for lower stock returns. Why do I say the potential? Well, if you believed that part of the reason we had, instead of 10% average return for the S&P, we've had 15%, in the last 10 years. If you believe it would be reasonable to assume that a part of that 5% increase was due to the fact that there was a lot of money around. The Federal Reserve was pumping a lot of money. If you believe that's true, but I do, that a good part of those excess returns was due to the Fed, it would be reasonable to assume that if they're withdrawing money, liquidity, then you might be in for a period of below normal returns. That doesn't mean negative necessarily, although it could. But instead of 10% average returns, maybe you're only going to get 5% average returns in the next few years. There are a lot of people who think that's a reasonable calculation. And by the way, I do too. This is really tough to figure out. It was tough to figure out. COVID really threw a monkey wrench into everything. And now you throw the Ukraine in, it's a very delicate situation. So look at next week, Powell and the Federal Reserve are meeting. They have to decide what to do. And they've made it clear. Powell has held our hand and said, we're going to go very slow. We're going to raise rates 25 basis points next week. We're going to start the process. Likely, they'll raise another 25 basis point at the next meeting, another 25, and probably just stop and look around and see how it's going. That's the most likely path right now. Go slow because they're not quite sure what's going on. So you can see how tricky it is. You see how the market's just going all over the place. It doesn't quite know what to do because there are a lot of what is called known unknowns. We just don't know the outlook of this Ukraine thing right now. And that makes them a little bit cautious, and they should be.
So another thing that people are watching right now is the energy sector. So where do energy stocks like Chevron or ExxonMobil stand right now?
They're making gobs of money. There's a reason they're outperforming. There are literally oceans coming in. Remember, oil was, not that long ago, it was $75. It's north of 100 now. That means they're making money, believe me. Not only are they making money, but their bottom line is higher. So they have what's called cash flow. And they are returning that to investors in the buybacks and dividends. They're also doing some more capital expenditures. There is some disappointment, I think, from the Biden administration when the companies have said they're going to be very disciplined. This is a word that the oil industry uses, meaning don't expect us to go out and pump as much as we possibly can. Because in the past, they've done that, and all of a sudden, oil's come back down, and they're stuck with still very high production costs because they're out pumping oil with these wells, and demand is lower. So this word disciplined basically says, we'll see. And of course, the United States needs a lot more oil now that this whole Russian thing is existing. You see President Biden has gone to the Saudis and asked them to use more oil because they're one of the few countries in the world that can actually pump more oil at demand. They have the capacity to instantly turn on more oil. Almost nobody does. Nobody else does. The Saudis have been basically giving him a cold shoulder, I think, because the Saudis want more help with their war. That's maybe not a war, but they're there's a lot of course, disputes between the Saudi and the Iranians, and Yemen is a proxy war, and they want more help. Biden administration, I think, is probably not providing the help they want. So they literally didn't answer his phone. President Biden called the Saudis to want to say, help us out here, pump more oil. They didn't answer the phone. They literally did not take his phone call. It's hard to believe. I found it hard to believe, but that was the story. So there's limited supply and very heavy demand. That's simply the way to understand it. So these companies are making gobs of money. Now, here's a prediction. This is not going to be hard. This is not a hard prediction. These companies are going to get a lot of crap from people in the next few months when people see the amount of money they're making. And they're going to be furious. But this is called capitalism. I don't know why people would be furious. They're naturally targets, greedy capitalist bastards. But the price went up of their primary commodity, and people are shocked that they're making more money. It's kind of silly as a, financial reporter watching this. It's like, duh, you're surprised. But trust me, these oil companies are going to get a lot of crap in the next few months, and it'll be interesting to watch that play out.
All right, so switching topics here a little bit to tech. Amazon this week announced a 20-for-1 stock split. What does that mean for investors, Bob?
I love stock splits. I've been here a long time, and there was a big thing in the 1990s. In theory, stock splits are meaningless. In theory, in fundamental analysis, they don't do anything. Think about it. You know, you don't get more value. You don't. All you get is more shares and a reduced price. So it doesn't add anything at all. In theory, it should not make any difference at all in a price of a stock. And yet, the academic literature that studied this indicates that it does. Why? Well, what does that mean when I say it does make a difference? The evidence is that stocks that split tend to outperform the overall market in the year or so after the announcement is made. And this evidence of this goes back more than 20 years. Why? It's probably behavioral economics and partly just very simple market momentum. Stocks that split tend to have the ones that are going up the most. Duh. And so those are stocks that have momentum. So there's a lot of people already buying into them. When they split, it sort of sends an announcement to other people who are not in the market that, oh my God, this stock is doing really well, and it makes other people pile in who are not already owners of the stock. This is one of those amazing behavioral economics things, because under strict fundamental analysis, there's no reason why anyone would buy the stock just because it's split, because the fundamentals don't change at all. And yet, you see, they do. Behavioral economics explains this by saying, people want in. It's the fear of, it's the FOMO thing, the fear of missing out when they see, oh my God, it's split. It's been doing really well. Look at that. Wow, Amazon's up, think about it. Amazing amount. And Amazon it's one of the great momentum stocks. In the last 10 years, the S&P is up about 200%. I think Amazon's up 1,400%. But that's Amazon. There aren't any stocks like that other than Microsoft and Apple and a few of the other names, but pretty hard to find that kind of momentum. One thing you didn't ask about was the buyback. They announced this $10 billion buyback. Here's where I've got a problem. Buybacks are a lot of baloney in many cases. The purpose of a buyback is to buy back stock, but the purpose is to reduce your share count. If you don't reduce your share count, it doesn't matter, because reducing share count improves the earnings per share. And that's what you want. You want more earnings going to fewer people on the shares. The problem is a lot of these companies announce buybacks and they never actually reduce the share count. Why? Because they give options, new options out on the other end to executives. So it's like a giant swimming pool where you've got a plug on the bottom and you pull the plug and water's going out at the bottom. That's buying back stock. And then you've got a hose at the top putting water into the thing. That's the companies granting new options to the executives who, of course, exercise the options at some point. You see, it's like a giant hamster wheel. The share count of the S&P 500 has not gone down in several years. It's about the same. And yet we have seen $3 trillion. That's a real number. In the last 3 or 4 years, close to $3 trillion has been spent on buybacks. And the overall share count has not declined. Now, some companies really do reduce their share count. Apple, for example, really does reduce their share count. It's gone down noticeably in the last 7, 8, 9 years. Oracle's another one. I can give you a list of them. People who follow this know this. This is why I have a problem. Amazon is not one of them. Amazon has consistently increased its share count almost every single year since it went public in 1997. Almost every single year. Now, maybe there's $10 billion buyback, and they haven't bought back any stock in several years. Maybe it'll make a difference. Maybe they'll reduce their share count. But please look for companies that are reducing their share count and not just announcing a buyback. It annoys me when I see that. We'll see if this buyback actually reduces the share count. Sorry to go on a rant, but buybacks annoy me sometimes.
Yeah, well, I'm glad you brought that up, Bob.
I would rather see, this is my personal opinion, I would rather see money returned to shareholders in the form of dividends. Why? Because a dividend is cash in hand. You get real money. A buyback, you don't get anything. You get this vague promise, oh, we're buying back stock. So the implication is we're going to reduce the share count. But a lot of times it doesn't reduce the share count. So it's a bunch of hooey. I'd rather get dividends. I'd also rather see people spend more money investing in the companies, investing in the businesses, if they're viable businesses. That's the big thing. So I don't know. This is I have gradually come to be very critical of buybacks. I'm in favor of cash flow, returning cash to shareholders. Oh yeah, I vote yes, but I'd rather see dividends. Now, the reason companies don't want to do this, by the way, is number one, these options make a lot of money for the executives. Number two, when you do a dividend, it's almost like a promise. You can't pull a dividend back. If you cancel a dividend saying, we had a shitty year, we're not paying a dividend. Oh, that'll be an uproar because people buy these things based on dividends. Buybacks or not, if somebody just announced we've suspended the buyback, nobody's going to go freak out on you. So dividends are harder to go back on than buybacks. And that's why executives don't like them. But I don't care. And as an investor, I'd rather get a dividend anytime.
Yeah, that makes sense. Well, thanks, Bob, for explaining that, because I think it's really helpful information for everyone to understand. So our next question is about the Nasdaq. Where do you think the Nasdaq is going from here?
Oh, I have no idea. What you're really saying is, where do I think big cap technology stocks are going, or even Cathie Wood stocks, speculative tech is going? There's a very simple problem. Yes, Apple is consistently profitable, Microsoft and everything else, but most tech stocks are based primarily on how much future earnings growth you can get out of them, because they tend to be high growth. And when you have a situation where interest rates are going up, the way the stock market values stocks, it's on a future stream of earnings. It's called a discount cash flow model. How much the XYZ company how much will they make 1 year from now, 2 years from now, 3 years from now in terms of cash flow? And what's that worth today? It's called discount. Right? Today, what's that future stream of cash flow? When interest rates go up, remember, things like bonds compete with the stock market. When bond yields go up, they make bonds more attractive and certain stocks less attractive. It tends to make stocks that trade on a belief that earnings growth is going to be strong a little less valuable. And that's why growth and technology stocks tend to get hit. Now, they can do fine if the increase in the interest rates is very slow. But if it happens very quickly, those stocks will get hit. Particularly companies that either don't make money, don't have the prospects for making money for several years from now, or have PE multiples that are like 100 or 200 times forward earnings. What does that mean? It means that the company is really not making any money. I mean, it might be making a few pennies, but if you trade from 150 times forward earnings, that's barely making money. So those tend to be the speculative tech names. We call them Cathie Wood stocks now, but there are many others, but shows a lot of those. And that's the ones that got hit the most. So the basic story about growth and technology is great. You saw with COVID, tech stocks became more valuable because we're moving in a direction where there's more software controlling the world. Software eats the world. And that's great. The issue is not whether technology is working or whether these companies are good. Most of them are great companies. The question is, how profitable are some of them going to be? Primarily, how profitable going to be, and what's the right price? There's a point investors are going to say, wait a minute, 150 times forward earnings? That's not making any money at all. Or this company's not going to make any money for 5 years. This happened in the late 90s. Suddenly in 2000, middle of 2000, people said, you know what? A lot of these companies are never going to make any money, or they won't for years, and I'm no longer willing. Now, why did they suddenly change their mind when they were very happy in 1999? Psychology changed, things changed, life changes, interest rates went up. Suddenly people started looking at them more carefully. In our case, we had COVID, we had Ukraine, so there's a lot of good reasons. But people change, and they change the way they look at things. I'm a big believer in technology. I want more change. Tech offers change, improvement in people's lives. Of course, who wants that? The question is, how much are you willing to pay for it? And that's what's changed. So I don't know if you're asking me about investment advice in technology, but I vote yes on more technology. I vote yes for more tech stocks. And the question is, what's the right price for you to own them at?
All right, thanks, Bob. And our last question, I really like this one. Someone was asking for ideas for investing $1,000. So if I have $1,000, how should I invest it?
Well, it depends on how old you are, but let's just say you're 30 years old or 40 years old. People ask me this all the time, first-time investors. I'll tell you, I'm not a financial advisor. I'm not going to give you financial advice. I'll tell you what I own. My core holding, I'm not allowed to own individual stocks or bonds. We never have been on those of us who are on the reporting side of CNBC. I can only own mutual funds and ETFs. And I can own my own company stock, which is Comcast. My single biggest holding is the S&P 500. You can buy the S&P 500 easily. It's an ETF. There are many different ways you can buy it. IVV is iShares. Vanguard has one, VOO. They charge 3 basis points. 3 basis points means that every year you'll get charged $3 for every 10,000 you have invested. That's pretty dirt cheap. Most owners of mutual funds charge 80 to 100 basis points, 3 basis points, and you own the biggest part. The S&P 500 is 80% of the U.S. stock market. In one fell swoop, one stock, one ETF, you can own 80% of the U.S. stock market. Now, who wouldn't want to do that as a core holding? That's what I have. I've had it for years. What you think you're brilliant? Go ahead, knock yourself out. Find the next Cathie Wood stock. You're probably going to be wrong. You're probably not going to figure out Microsoft in 1995. You're probably not. But go ahead. You'll find you'll become a momentum trader. You'll find it's almost impossible to outperform the overall market. I don't mean this week, and you can tell your buddies you just made 10% on Tesla. I mean, do it week after week, year after year, consistently. And the academic studies are overwhelming. Not only do retail investors not outperform the market, professional investors do not either. The biggest study that's done on this every year, S&P, Standard & Poor's, does a thing called the SPIVA study, where they look at the performance of professional fund managers, not amateurs, not retailers, professional fund managers, and they find even in a 1-year period, less than 50% beat the market. Over 10 years, 85% of professional fund managers underperform the market. When you account for the fees that they charge and the fact that there's a thing called survivorship bias, a lot of them just fold up. They're terrible. 50% of all funds close after 10 years because they're terrible. They lose so much money. They're awful. What does this tell you? I've been sitting here for 32 years at CNBC. I have concluded, I just told you. My biggest holding is the S&P 500. Because even if I wasn't restricted, I still wouldn't be a stock picker. It's very difficult. Now, we have people on our area who are great stock pickers. They're, I think, very highly of, and even Jack Bogle, the head of Vanguard, who was against trading a lot, admitted people like to try to pick stocks. It's just an innate thing. He had very good, Vanguard still does have excellent active management. But Bogle never wavered in his belief that ultimately the average investor is better served by just staying with the market and owning the market. And that's the S&P 500. So if you want, you can have different flavors of that. You can invest a little overseas too. There's very good ETFs that invest overseas. You can look at EFA, which is EFA. It's called Europe, Africa, Far East. That's a big international ETF. There's bond ETFs here. You can debate what percentages you should own. It's largely around how old you are, what your risk tolerance is. And beyond that, stay in the market, stay steady. This is another Bogle precept. You can't do market timing, because to get market timing right, you have to be right going in, and then you have to be right going out. You have to make two decisions perfectly, and nobody does that. The academic literature is overwhelming. It's really hard to do that. If you're 75 years old now and you're nervous and you're going to need, all of your money in the next few years, well, that means your risk tolerance is low. And maybe you should not have, if you have 75% of your savings in the stock market, maybe you should have less. That's a good situation where you might consider it. But if you're 30 years old, you should not be worried about the Ukraine. You should have a philosophical belief. This is my personal belief. I believe in America. I believe in capitalism. I believe in the future of the country. I am much older than 30 years old, but I have very large amounts still in the stock market, because I believe that I'm going to live for a long time, till about 90. That's about as far as I'm going to go out on a limb. And because of that, that's another, more than 20 years for me. So I'm pretty optimistic about the country. I think the Ukraine thing, I think is very important. One of the most important things in decades. But long term, if you're 30 years old, you've got a lot of time ahead of you. If you don't believe in the United States, if you don't believe in capitalism, if you don't believe in the future of the country, well, and for crying out loud, what are you investing in the stock market at all? I hope you wouldn't feel that way, though. I'd hope you'd be like me, believe in the country, believe in the future. And that's what's going on in the Ukraine, by the way. A lot of this is about things like freedom and democracy. We are the beacon of hope of the world. The United States still is. It's not corny or nonsense. It's really real and very true. And we need to stand up for freedom and democracy. I know I'm sounding like a little bit of an editorial, but this is a very, very important moment. This is one of the big moments since World War II. They're going to study this year for decades, historians. It's an important year, and I normally don't go out on a limb like that, but you're not paying attention if you don't see what's going on here. It's freedom and democracy versus people who don't want freedom and democracy. Sorry to get on my soapbox, Katie, but I feel pretty strongly about this.
Yeah, of course. Thanks, Bob. I mean, the world is watching, so we will continue to watch and see how this situation in Ukraine unfolds. But thank you again for answering all these questions. Thank you to everyone for sending them in. Great questions, as usual. So I appreciate all of your answers, Bob. Thank you.
Yeah, I love answering general investment questions because it's the most important thing, and it's very easy, a lot easier than it was when I started in 1990 at CNBC to invest in the broad stock market. It was just about impossible. Vanguard had an S&P 500 fund back then, but it was really hard. And now it's just a lot easier. The hard part is to resist the urge to trade a lot. Be careful about that.
Mm-hmm. Yeah, because it's certainly easier to do that as well now. So thank you, Bob. I appreciate it. And we'll see you again in a couple of weeks.
Look forward to that. Thank you, everybody. Have a good week.